Many of you call me Dr. Frankenstein, the guy who helped create the mortgage security market that blew up the world.
You invented the mortgage-backed securities, which really changed the face of finance. They were also, of course, blamed for the financial crisis.
September 15, 2008, Lehman Brothers filed for bankruptcy. In 24 hours, $14 trillion in wealth vanished from the global economy, more than the entire GDP of China at the time, and 4 million families lost their homes. But few people know that this catastrophe began with the invention of just one man, 30 years before it even happened.
You might not know who he is, but he changed your life more than Michael Jordan, the iPod, and YouTube put together.
His name was Lewis Ranieri, and the financial instrument he created in 1977 was supposed to help millions of Americans buy homes. And within a decade, every bank, pension fund, and government on Earth was connected to it.
And then 30 years later, in 2008, it all came crashing down. In the end, Lewis Ranieri's mortgage-backed security mutated into a monstrosity that collapsed the whole world economy.
So how did a mailroom kid from Brooklyn end up destroying the whole world economy? In the 1970s, if you wanted to buy a house, you walked into your local bank and asked for a loan. If the bank had money, you got one. If it didn't, you were out of luck. A family in Kansas could be denied a home loan, but simply because their local savings bank had run dry. Meanwhile, a bank across the country might be sitting on millions with nowhere to put it. And one man saw a solution. What if he could take thousands of individual home mortgages, bundle them together into a single bond, and sell that bond to investors anywhere in the world?
You see, Lewis didn't know it yet, but he'd already changed banking forever with one simple idea.
The mortgage-backed security, or private label MBS. You've got your average person's mortgage, fixed rate, 30 years, boring. Safe, small payoff, right? But when you have thousands of them all bundled together, suddenly the yield goes up, but the risk is still small because, well, they're mortgages. And who the hell doesn't pay their mortgage?
What exactly is the credit rating on this bond?
This bond, gentlemen, is AAA rated.
This is exactly what the Michigan State Pension Fund has been looking for. I'll buy 20 million.
Oh, come on, live a little.
25 million.
The money came raining down.
That was the mortgage-backed security. Pension funds bought them, insurance companies bought them, Japanese banks, Swiss institutions, Greek shipping tycoons. Money from around the world now flowed directly to Americans' families buying homes. But the man who wired the global financial system to American mortgages wasn't some Ivy League economist. He was a college dropout from Brooklyn who dreamed of becoming an Italian chef. And to understand how he ended up changing the world, we have to go back to the beginning. Lewis Ranieri was born into an Italian immigrant family with nothing. His father drove a taxi and his mother did needlework to keep the lights on. As a kid, Ranieri had one dream. He wanted to become an Italian chef. He loved the chaos of kitchens, the smells, the heat, the noise. But a head-on car accident on Brooklyn Snake Hill rekindled a childhood asthma condition. His lungs couldn't handle kitchen fumes anymore. The dream was dead and he had nothing to replace it with. So in 1968, with no plan and no connections, a 20-year-old college sophomore walked through the doors of Salomon Brothers, one of the most ruthless bond trading houses on Wall Street. He wasn't there to trade, he was there to sort the mail. $70 a week, night shifts. But even in the mailroom, Ranieri couldn't help himself. He figured out the staff was wasting money on postage. So he drew a postal zone map on the wall and cut costs overnight. So they made him supervisor and dropped out of college the same week. And then his wife fell gravely ill. Hospital bills hit $10,000. He was broke and desperate. So he walked into a Salomon partner's office and asked for help. The partner didn't hesitate. $10,000 on the spot, not a loan, just paid. Ranieri never forgot that. Because that moment defined what Salomon Brothers was to him. Not a corporation, it was a family. And that's exactly what made what happened later so devastating. In 1974, a trader named Bob Dahl saw something in Ranieri and moved him out of the mailroom onto the trading floor.
Hiya, Frank. How are the wife and kids? You know, for you, I'm considering treasury bonds and utility stocks. Smoke?
In the late 70s, banking wasn't a job you went into to make large sums of money. It was a fucking snooze.
How about those Mets?
Filled with losers, like selling insurance or accounting. And if banking was boring, then the bond department at the bank was straight up comatose. We all know about bonds. You give them to your snot-nosed kid when he turns 15. Maybe when he's 30, he makes $100. Boring.
Mortgages. At the time, mortgages were the joke of Wall Street. One corporate trader, when asked who those people in the corner were, simply answered, nobody. Mortgages. They're a nothing department. But Ranieri had spent 6 years in the mailroom watching how every part of Salomon worked. He understood something nobody else did. Mortgages weren't small. There were trillions of dollars of mortgages sitting in local banks and doing absolutely nothing. If you could turn those mortgages into bonds, you could move that money. And if you could move that money, you could change the world. So in 1977, he structured the first private mortgage-backed security. And boy, did the mortgage-backed security make Salomon Brothers unstoppable.
I'll buy 20 million.
Oh, come on, live a little.
25 million.
The money came raining down. And for the first time, the banker went from the country club to the strip club. Pretty soon, stocks and savings were almost inconsequential. They were doing 50, 100, 200 billion in mortgage bonds and dozens of other securities a year. And America barely noticed as its #1 industry became boring old banking.
By 1985, the mortgage department was producing nearly half the firm's total profits. Ranieri didn't just build a product, he built a brotherhood, feeding Frenzy Fridays Atlantic City by helicopters. Traders so loyal, they would follow him everywhere. Because Ranieri treated them the way Salomon had treated him when his wife was sick. In December 1985, the CEO of Salomon Brothers, Gottfried, told a reporter, Louis is very definitely on the short list of potential future chairmen. The mailroom kid was now running the engine of the most profitable investment bank in the world. But the higher Ranieri climbed, the more enemies he made. And inside the bank, there were people who had been waiting for exactly the right moment to destroy him. At its peak, Ranieri's mortgage department wasn't just profitable, it was a kingdom within a corporation. But the louder his department got, the more it infuriated the men who thought they ran Salomon Brothers. So in 1986, the CEO Gottfried created an office of the chairman, a three-way power structure that put Ranieri alongside Tom Strauss. On paper, collective leadership. In practice, a war. Strauss was everything Ranieri wasn't, tall, thin and tanned. The mortgage department with its polyester suits offended him on a cellular level. Strauss planted a man named Mark Smith inside the mortgage department. The traders called him a Trojan horse. Smith systematically dismantled the Ranieri family, moving key traders out and bringing outsiders in. He stole the profits from the mortgage group to cover his own losses. So in December 1986, Gottfried quietly removed Ranieri from the mortgage trading. Then on July 16, 1987, they fired him. The meeting lasted 10 minutes. It took place at a law firm across the town. Ranieri arrived thinking it was about something else entirely. Now Gottfried gave 3 reasons. Nobody likes you anymore. You're a disruptive force. You've become too big for Salomon Brothers. When Ranieri stood up to collect his belongings, Gottfried told him he wouldn't be permitted back in the building. 18 years! From the mailroom at $70 a week to vice chairman, and he wasn't even allowed to collect his own things. The purge was swift. Matera was fired the next day, then Ditona, Di Pascal, Maro, Ganella. The entire founding family of the mortgage-backed security department was gone within months. One surviving Italian trader showed up for work wearing a button on his shirt. "Find me, I'm Italian." Lewis Ranieri never accepted that Gottfried betrayed him willingly. To the end, he preferred to believe that the firm that paid his wife's hospital bills was temporarily in the hands of strangers. But it didn't matter what Ranieri believed. The man who invented the mortgage-backed security was out, but the machine he built, that was just getting started. Here's what made Ranieri's invention safe. He built it for borrowers with jobs, verified income, and down payments, real people making real payments on real houses. But once Ranieri was gone, the only person on Wall Street who understood both the math and the risk had no seat at the table anymore. And the people who replaced him saw something different in his blueprint. Not a way to help families buying homes, a way to make anything look safe. Because Ranieri's invention had done something nobody fully appreciated yet. It separated the lender from the risk. In the old system, if you stopped paying your mortgage, the bank lost money. So banks were careful. But with securitization, the bank could sell your loan the day after you signed it. Your default was now someone else's problem. The incentive to be responsible completely disappeared, and the people about to exploit that had no idea what they were playing with.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities.
In the late 1980s, Michael Milken's team at Drexel Burnham Lambert took Ranieri's method and applied it to junk bonds. They called it a collateralized debt obligation, a CDO. Now this is very important to understand. Ranieri bundled actual mortgages, real loans with real monthly payments from real homeowners. The CDO bundled other bonds, derivatives of derivatives. Every layer added another step of distance from reality. And if the foundation was rotten, every layer above it would collapse. But the CDO was only the blueprint. Someone still had to fill it with the dynamite.
Charged Mazzillo and two former deputies with fraud. They say Mazzillo dumped nearly $140 million in Countrywide stock using inside information about the dangers the company faced by underwriting high-risk mortgages.
A decade later, a mortgage lender named Angelo Musillo was about to take Ranieri's invention in a direction Ranieri never imagined. In 1997, Musillo's company Countrywide Financial launched Full Spectrum Lending, a subprime mortgage unit. The first year revenue, $140 million. Musillo built them for anyone with a pulse. The borrower didn't need to verify his income, or prove his employment, or put a single dollar down. The industry simply called them liar loans, and they said it with a straight face too. By 2004, Countrywide was the largest mortgage originator in America. By 2006, 36% of all their loans were stated documentation. The borrower just wrote down a number and nobody checked. And in April 2006, Musillo sent an internal email about Countrywide's subprime loans. In all my years in the business, I have never seen a more toxic product. 1 month later, he told investors publicly they were a sound investment. Between 2001 and 2006, Angelo Musillo took home $470 million in compensation. Lewis Ranieri saw what was happening. He knew these loans would never survive a downturn, but he had been locked out of his own system. But the subprime mortgages was only half the problem. Someone had to insure them. In 1998, JP Morgan approached a man named Joseph Casano at AIG, one of the largest insurance companies on earth, with an idea. We'll pay you a premium. You insure our mortgage-backed securities. If the mortgage default, you pay us. They called it credit default swap. Let's bring back Matt Damon to explain.
For investors who owned CDOs, credit default swaps worked like an insurance policy. An investor who purchased a credit default swap paid AIG a quarterly premium. If the CDO went bad, AIG promised to pay the investor for their losses. But unlike regular insurance, speculators could also buy credit default swaps from AIG in order to bet against CDOs they didn't own.
In insurance, you can only insure something you own. Let's say you and I own property. I own a house. I can only insure that house once. The derivatives universe essentially enables anybody to actually insure that house. So you could insure that, somebody else could do that, so 50 people might insure my house. So what happens is, if my house burns down, now the number of losses in the system becomes proportionately larger.
Since credit default swaps were unregulated, AIG didn't have to put aside any money to cover potential losses. Instead, AIG paid its employees huge cash bonuses as soon as contracts were signed. But if the CDOs later went bad, AIG would be on the hook.
Cassano figured AIG would collect premiums forever and never have to pay out. So between 1998 and 2005, Joseph Cassano sold more than $60 billion in credit default swaps on mortgage-backed securities. And he did it without posting a single dollar of collateral. That meant even if a fraction of those mortgages went bad, AIG would owe tens of billions it simply did not have. In 2007, Cassano testified before Congress. They asked him about the risk.
It's hard for us, without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1 in any of those transactions.
He was being paid $43.6 million a year. So now the chain was complete. Mozillo made the bad loans and Wall Street packaged them into CDOs, and Cassano, he insured the whole thing with money AIG didn't have. The rating agencies rated 80% of these CDOs as AAA, the same rating as the US Treasury bonds. Moody's alone stamped 45,000 mortgage securities with their highest seal of approval in 2006, 30 per working day. The same mortgages Mozillo privately called toxic. In December 2006, Ranieri publicly warned regulators that the quality of mortgage-backed securities was falling apart. Nobody listened. We could never have imagined that the rating services could be bought, he later said. That the money would be so important, they would break all of their own rules. In the early 2007, the first cracks appeared. Bear Stearns subprime hedge funds collapsed. Mortgage defaults started climbing. The rating agencies began their first downgrades. But Wall Street didn't care. They kept going. Countrywide kept lending. AIG kept insuring. Nobody wanted to believe the music was about to stop. By the summer of 2008, everything came crashing down. Bear Stearns had already collapsed in March. Mortgage defaults were surging across the country. And then, on September 15, the unthinkable happened.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
The next day, the interbank lending market froze completely. The banks stopped trusting each other. Nobody knew which bank would fall next. The government scrambled. AIG needed $182 billion in taxpayer money to stay alive. The largest corporate bailout in American history. $11 trillion in American household wealth evaporated. 4 million families lost their homes. 9 million people lost their jobs. And the instrument at the center of it all was the mortgage-backed security. The very thing Lewis Ranieri built 30 years earlier.
And when all was said and done, only one single banker went to jail. This poor schmuck, Kareem Sarah-Geldon from Credit Suisse. He hit a few billion in mortgage bond losses, something most of the big banks did on a good day during the crisis.
While the men who weaponized his invention and collected severance packages and consulting fees, Ranieri went the other direction. In 2007, before the crash had even fully hit, he founded Celine Finance, a company that bought distressed mortgages and restructured them so families could stay in their homes. He called them services of the soul. He was trying to undo the damage, trying to save the homes his invention had been used to destroy. But the crisis caught him too. In November 2008, his own bank, Franklin Bank Corporation, was seized by the FDIC, the third largest bank failure of the entire crisis. It cost the Deposit Insurance Fund $1.4 billion. Ranieri watched his own bank get destroyed by the very monster his securities had become. And in 2017, he sat down for an interview with institutional investor. The headline, "I blew up the world."
We've now created Frankenstein. Frankenstein has a brain. It's the one we gave him. But the body made up of everybody's, whatever parts they got out of the cemetery, has nothing to do with necessarily what we started.
"We have now created Frankenstein," he said. "Frankenstein has a brain. It's the one we gave him. But the body, made up of everybody's, whatever parts they got out of the cemetery, has nothing to do with what we started." A year later, the Wall Street Journal, his most painful interview. "I'm the guy who played a central role in this whole thing, and I regret it because it got abused beyond everybody's imagination. I will never, ever, ever, ever live out that scar that I carry for what happened with something I created." Dick Fuld, the CEO of Lehman Brothers, blamed the market. Angelo Mozilo settled with the SEC for $67 million and walked away. Joseph Casano got $1 million per month as a consultant after AIG collapsed. But Lewis Ranieri carries the scar because he understands that the thing he built to help people buy homes became the very weapon that destroyed them. And here's the most disturbing part. It's happening all over again. Right now, collateralized loan obligations work almost exactly like the CDOs that crashed in 2008. Except now they're backed by corporate loans instead of mortgages. The CLO market is worth $1.4 trillion, bigger than the subprime ever was. Janet Tavakoli, one of the few experts who actually warned about CDOs before 2008, put it plainly, "We're doing it again. We have learned nothing." Remember the mortgage-backed security, the CDO. Remember what they did in 2008. Because if you don't, Lewis Ranieri's scar won't just be his, it'll be ours.